Hello, welcome back to another video. In today's video, I'll be covering quality stocks with different types of moats that are down massively year to date. So for reference, this is my portfolio. I'll be covering some of my stocks in here. And first and foremost, I would like to talk about my investment philosophy first. So what I tend to do, what I like to do, is I like to buy exceedingly high quality businesses that have long runways of growth with some catalyst plays here and there. So in today's video, I'll be covering the stocks that are down massively that have different modes and different models. And the first type of mode that I'll be covering today is something called an in-stock-based management type mode. So in-stock-based management is an extremely predictable stream of income coming into the business because the company built the machines and they sold these machines to the customer. And so the customers will have to come back to basically service the machines. So all these different businesses, they have highly recurring revenues with low churn rate, with built-in price increases, which allows them to grow steadily in the markets today. And two stocks that I'll be highlighting today include Otis as well as Intuitive Surgical. So Otis is a stock that is now around 3% year to date. It is currently trading at a 23 times earnings. Intuitive Surgical is now around 8% year to date, currently trading at a 66 times earnings. I'll be talking about Otis today. So Otis is down because the China housing market is slowing. So the company is seeing decrease in terms of the number of lifts that is being built, because your China housing market is weakening. And once we see the recovery in this Chinese portion, then Otis will likely see an increase in terms of its revenue and a normalization of growth. The market has been weakened over the past few years, but I don't expect this to continue on for a very long time. Once we see recovery in that portion, Otis will probably see low teens growth again, which is what the company was historically able to do before the housing crisis in China. So Otis is a highly predictable business, and with low teens growth at a 20 times earnings, this could get a lot more interesting. The next type of mode that I'll be covering is regulatory modes. So a regulatory mode is a type of economic mode where a company's competitive advantage comes from government regulations. So this makes it hard for competitors to come into the space because they'll have to pass by all these different regulations, and some regulations don't even allow competitors to come into the space. And for today, I'll be covering two stocks for this portion. The first stock is FICO, of course, and the second stock is United Health. So FICO is a stock that is now around 30% year to date, currently trading at a 54 times of earnings. And the other stock, which is United Health, is now around 40% year to date, currently trading at a 12 times of earnings. So for FICO, it is down after your Vantage Score report, but the fact is that your tri-merge is still present, which is a tailwind for the company. The company will still be able to continue increasing prices because your FHFA, they can't stop FICO from increasing prices. The only way FICO is stopped in terms of its price increases is through the DOJ. If the DOJ decides to sue FICO, then that's a different story. So for FICO, the FHFA won't be able to stop them from increasing prices. And currently, FICO is the most trusted credit score out there, so there's no way for your mortgage companies to switch out of it. And FICO's current score, the FICO 10T score, is also a lot more predictable as compared to your Vantage score. So for FICO, it is sort of like a built-in mode. It's a regulatory mode because it's built in your tri-merge report. It is required in all your mortgage-backed securities in the US. On top of your Vantage score, it is required in all of your mortgage-backed securities in the US, more than 90%. So for FICO, it is a quality business that has a strong regulatory backing, and I don't see this changing anytime soon. The next company that is sort of like in a regulatory mode as well is United Health. So United Health, as well as all the other big insurance companies in the US, is protected by regulation because you have your CMS ratings, and when you have your CMS ratings, all the small companies that want to come into the space, they cannot simply apply for CMS ratings because they won't get a high rating for them. So this is sort of like protection for the incumbent. And besides that, ACA, Medicare, as well as Medicaid, there are rules in place which makes it hard for your competitors to come into the space. And that is sort of like a moat for all these insurance companies, especially the big ones. So the big ones, they'll be able to continue making the most profit, which is something that is overlooked by a lot of investors. So of course, the healthcare insurance sector is down as a whole, but for United Health, it is a quality business in this space, especially since United Health is the largest provider in the entire insurance space. The next mode that I'll be covering is network effects. So network effects is when a company has a flywheel that keeps on turning, so driving the company and making it even bigger. So for example, you have Amazon with their flywheel. So Amazon has buyers on their platform, and more buyers leads to more sellers, which leads to even more buyers, and so on. So that is sort of like a moat in itself as well. And you have other social media companies like, for example, Meta, Meta with their Instagram platform is sort of like a network effect mode as well. So for today, I'll be covering a stock that has a strong network effect that's down massively year to date. So this stock is Moat. Moat is down around 15% year to date, currently trading at a 31 times of earnings. So Moat is a company that has a strong network effect. It is basically the Amazon for your used and your salvage cars, in the US especially. So this is a company that is high quality, that is down massively year to date. So for Moat, the company has an amazing flywheel business. The company is down due to slower growth, but the markets are understating its ability to grow internationally, as well as the potential tailwinds for this company. So when your interest rates, when they eventually come down, your used car prices, they will go up because there will be higher demands for them at a much cheaper rate. So for Moat, they could be a beneficiary of this. And besides that, their international portion makes up around 18% of their total revenue today, and that segment is actually growing quite rapidly. They have dominant market share in countries like the UK, where they hold around 50%, and if those portions can continue growing, then this could be a tailwind for a company like Moat. The next type of moat that I'll be covering is your switching cost moat. So switching costs exist when a customer faces problems, financial, time, or effort-wise, to switch to another provider. So take for example S&P Global. S&P Global and Moody's with their ratings. The customers can't switch away from S&P Global as well as Moody's because it will literally cost them more if they were to switch to someone that offers it for free. Same thing for FICO with your mortgage-backed securities. Your FICO score will lead to 0 to 100 basis point lesser in terms of the interest rate as compared to Vantage score in the US. So these two companies, they have high switching costs. And for today's video, I'll be covering another company that has high switching costs. And this company is Constellation Software. So for Constellation Software, they're a serial acquirer. What they do is they buy a lot of different businesses, a lot of software companies in niche markets, which has high switching costs. So the company is down around 2% year to date, currently trading at 100 times earnings, but on a price to free cash flow basis, it is currently trading at around a 28 times multiple. So buying Constellation Software is like buying Berkshire Hathaway in their early years, because Constellation Software is a lot smaller than Berkshire Hathaway, so they have a lot more runways of growth. It is basically the law of large numbers. Mark Leonard is an incredible capital allocator, and the company has hundreds and hundreds of VMS software companies with high switching costs, targeting extremely niche markets, and I expect the company to be able to continue deploying this capital at high rates of return, given the culture of the company. So this is an interesting company that you could look at as well at its current price. Last type of moat that I'll be covering is your high barriers to entry. So for your high barriers to entry portion, I'll be highlighting two companies. One of it is Canadian National Railway, a new company coming into the space. We have to spend billions of dollars trying to build it up. So that's a high barriers to entry in terms of cost. And the other one is Cellnex. It's similar to Canadian National Railway. So all your cell towers in Spain, in Europe, for example, people will have to spend billions of dollars to build them up, which is not economically viable. And besides that, these companies have a geographical monopoly, because when they build out a cell tower in one of those places, it is not economically viable for a competitor to come into this space because they have to split the profits anyway. They won't be able to recover the cost for building the cell towers in this space. So these two companies are interesting. Cellnex is actually a company that Chris Hone owns. He has actually talked about the company before in one of those interviews. So if you're interested, you can go and check it out. The next portion that I'll be covering are two companies that reported earnings today. So these are the earnings for this week. I think the most interesting one will be on Thursday after market close, Intuit as well as this other company called Workday. But in today's video, I'll be covering Target as well as Estee Lauder. These two companies are down post earnings. So I'll be covering Target today first. Target is down around 6% after its earnings. It is currently trading at a 10 times of earnings. So for Target, their CEO actually announced plans to retire. I mean, the CEO's performance has been quite underwhelming over the past few years. The second quarter net sales was down around 1% year on year. Gross margins is down, diluted EPS is down 20% year on year, and comparable sales is down around 2% year on year. So the company actually beat estimates. It is less worse than expected. But the CEO announced plans to retire in 2026. I don't think it's a bad idea for the CEO to come down because the management has been performing quite poorly over the past few years. I mean, if you were to compare that performance to Walmart, to Costco, to all your different other grocery companies in the US, Target is the one that has been underperforming as compared to all these other different companies. Next company that I'll be covering is Estee Lauder. So Estee Lauder is down around 5% today, and from the April lows, this company is actually up around 100%. So for Estee Lauder, their earnings came in above estimates. So their EPS came in at 9 cents, which beat estimates. Revenues came in at 3.4 billion, slightly above forecast, but the company's full year guidance now is between $1 and $2 for fiscal 2026, which is next year in August. So the company now, at its current trading price of around $80 a share, is currently trading at a 40 times of earnings. So for Estee Lauder, it is a legacy luxury makeup company that is dying. So we're seeing more and more influencer-led brands coming up through Ulta Beauty, for example. So for Estee Lauder, I think it is a company that is slowly dying away, and this company is still expensive today at a 40 times of forward earnings. So this is a company that I will definitely stay away. It's a company that is weakening in terms of its moat, as well as the fundamentals. So for this company, it will be an avoid for me. Last portion, I'll be covering some questions. So the first one, it says, "Hi Guan, great video. Can you share your thoughts on Deutsche Börse AG? High profitability, steady growth, and a strong moat with them owning X Extra, the biggest stock exchange in Germany. Much appreciated." So my opinion is that Deutsche is a high quality business. It's a company that Chris Hone has talked about before. So your stock exchanges, for example, like in the US, you have your CME, you have Nasdaq, and so on. There's different companies that are incredibly high quality toll gate businesses. And Deutsche is also another company that I've looked at in the past. It is a toll gate business that is high quality as well, and I won't fault you for buying into this company. The next comment, it says, "The problem for you and every other hedge fund manager is that any dip will be bought up by your retail investors, so keep dreaming about a nice drawdown. There are plenty of wonderful companies at fair valuation. I'll see you when I'm rich and you'll still be waiting for the next drawdown." So this comment is interesting. I mean, I don't really mind missing out on gains. Market valuations are high today, and I don't want to overexpose myself to downside risk. Of course, it's up to you if you think the markets can keep going up in a straight line. But for me, I'll be waiting out for dips. I'll be waiting out for dips when valuations come down and company goes back down to fair value or maybe even undervalued before I start adding to them again. I think a company that is currently trading at around fair value or maybe slightly undervalued is Visa, which is why I've been adding to it. As for this comment and every dip will be bought by your retail investors, I don't think that is true. But hopefully it turns out this way so that no one loses money. I hope you guys have found this one useful and invest safe.